Rob's Child, nothing I say is investment advice. I wanted to do a quick market update. I feel like anyone out there that is following what's going on in the economy and interest rates and the yield curve and what the Fed's doing and inflation and all of these things, I feel like most people must know kind of where we are right now. But then again, maybe there's some people that don't, and I wanted to make it really simple and clear. From super long historical standards, stocks are considered today to be overvalued. In order for their value to make sense, companies need to continue to grow their ability to earn more and more and more money. And right now, from historical standards, they are very much overvalued. Right now, the S&P overall PE ratio is sitting at around 25. And for most of history, it's bounced around up and down between 7 and 20. Yes, all the way down to 7. That would mean the S&P 500 dropping by 66%, which is a humongous amount. Now, the excuse out there is that, okay, technology is better and markets are more efficient, so we can handle a higher PE ratio. Could be true, could not be true. Graham would not approve, I would say, kind of the godfather of analyzing securities and markets. Right now, on top of that, the Federal Reserve, the bank that sort of controls interest rates, that controls how easy it is to borrow money, is purposefully strangling the economy for it to weaken. And inflation is still at 3%, and their supposed target is 2%. And the last two business cycles where the Fed started to strangle, they got scared and unstrangled and then lit it on fire. And this happened the last two cycles, 2000, the dot-com bubble, and the financial crisis. Both situations were bailed out. This time, there will probably be less bailing out simply because inflation is high, and at the end of the day, stock prices don't matter to the Fed if inflation is a problem. Now, granted, I believe when inflation gets down to 2% and below 2%, and maybe even we hit some deflation, that the Fed might sit on their hands for a little bit. Just be like, hey, well, it was at 9% and we said average 2%, and so this is fine. On the other hand, that sort of automatically entails very high unemployment and a lot of economic problems, and so it's also easy to assume that the Fed's going to bail everybody out once again. The most important part of this story is that interest rates are very high and have broken out of a long-term downward trend since 1980. And this means that businesses that are very accustomed to holding a certain amount of debt and owing less and less money on that debt for the past 40 years, every 5 years it's less and less and less and less, and suddenly it jumps way up. And so companies are not going to be able to make as much money. And so that PE ratio, it wouldn't be unreasonable for stocks, especially just considering the S&P 500, to drop by 66%, to get down to that normal low point, as it does every once in a while. And because of how high it's been and how long it's been high, the PE ratio, that is, it may even go below there, which would mean even a greater decline of stock values than 66%. The bigger point of this whole video is that it's important to understand a PE ratio of 20 means that a company is earning 5% of the value of the company, indicated by the value of the shares, indicated by the price of the stocks. Right now, if you are borrowing money from the federal government, you are earning more than 5%. And this is risk-free money. Now, I'm not saying that the value of stocks, the value of your stock portfolios can't keep going up. They certainly can from here. But when you look at it from a point of risk and reward, it's not pretty to me. It is not pretty. It is not a pretty picture. Just to be clear, a PE ratio smaller, down to, let's say, 10, means that a company is earning a 10% yield on basically the value of the stock. So if you have $100 one stock, or a collection of stocks that is worth, per $100, the companies are making $10. In a case where it's 10, the PE ratio is 10. If it's 20, it's 5%. You get one, it's 1 to whatever the number the PE ratio is. That's how the ratio works. We could see an era in 1927 to 1929 or the dot-com bubble, where valuations of stocks sort of just go up and up and up, by people ignoring the facts of what it is that you own, what it is that you are buying, the actual value of stocks. And periods like that tend to end. They tend to end. I believe there are undervalued markets out there right now, including lithium, cannabis. Also, I believe dry bulk shipping and uranium. These areas are potentially undervalued. Also, emerging market equities, especially Brazil and China, where their PE ratios are closer to 7 and not 25 like they are in the United States. I believe even long bonds right now, yielding over 4.5%, are, from a super long-term historical standpoint, to be quite high. If you want to check out my video, I did one on a 670-year history of interest rates. So this is what I believe. This is where I think we're at. My hope with this video is to simply maybe clear up a few things on some people's minds that might see it. Again, none of this is investment advice. I just wanted to put a perspective out there because, it's funny. You hear a lot of people talk about how, stocks, they just go up and they go up forever. Real estate was like that before the Great Financial Crisis. Stocks were also like that in 1929, where it was just like, everyone's just going to keep getting more and more wealthy infinitely forever. I think it's wise to be cautious in this current environment. Again, like Benjamin Graham says, the stock market is not a weighing machine, it's a voting machine. And so there's nothing stopping people from bidding the price of stocks higher and higher and higher and higher and higher. But there's a lot of good reason to believe that the benchmark of U.S. stocks, the S&P 500, could be interpreted as being overvalued right now, and potentially by a very large amount. As what I did in one of my recent videos, I want to illustrate a certain point about PE ratios. I talked about it quite a bit, and for anyone that doesn't quite understand, think of it again like this. A PE ratio of 25 means you go to the store and you buy a $25 machine that prints you, or prints itself, $1 every year. It prints itself $1 a year to make it better so it can earn maybe more money in the future, or it can just give you the dollar. That's what the S&P 500 is doing for $25. It has gotten all the way down to $7 many times throughout history, and typically goes between $7 and $20 and doesn't typically go outside of that range. And right now it's at 25. So, would you go into a store and pay $25 today knowing that it can print $1 a year versus waiting maybe for a period where it's only $20 or $17 or $15 or even as low as $7? Which can occur and probably will occur at least at some point in the future. It's not hard to imagine that scenario. It is not out of the realm of possibilities. And I repeat again, this is not investment advice. I'm not a fortune teller. I am seeing what's going on, and I wanted to share that information and hope that it can provide an educational experience for some people that might see it. Rob's Child.